So I'm Jeff Tamburello, one of the directors of the Southwest Florida RIA, joined by the other director of the Southwest Florida RIA, the esteemed Michael Lyons. How are you doing today, Mike?
Good, man. How are you? Ready to discuss?
Yeah, so we wanted to talk about, it's all the rage in the industry right now. Syndications on multifamily have been the rage. There's a lot of them put together, a lot of them wound super tight. Recently, there was a guy that basically got his start on YouTube and then became a syndicator and just lost 3,200 units to foreclosure in Texas.
Yep.
So, and it's a really interesting, kind of deal to basically reverse engineer, because you've got the debt side. Nobody really seen this coming, where the Fed was going to, crank rates 10 times in a year.
Yeah.
So that was something, and particularly if you did not have fixed debt and you did not have at least a rate cap on the debt, that was troublesome. And then on top of that, rents are going down a little bit.
Yeah.
So you've got, your mortgage payment goes up and your rent goes down. That was 2007 here in Southwest Florida. That was actually 25% increase in taxes and insurance and a 25% decrease in rents. And then the foreclosure crisis happened when everybody gave up. But what are your thoughts, Mike? You manage properties every day. If you were to go through and underwrite one of the, because you can make a lot of money in these, and there's some times that you can tag along with some really great talent, that's done these a lot.
Yeah.
And then there's also, you may get a really smooth spoken guy who doesn't know anything about properties that you may give your money to as well. So what would you look for in these, Mike, because you manage properties and do this every day?
And I feel bad for those. That's really, anyone involved in that probably is losing and lost a lot of money, and that's just a horrible situation. Obviously, they didn't plan on the market doing what it did, but that's investing. That's the risk you run in investing. If I were to be approached by someone and they were, which you and I get approached all the time with stuff, not on this kind of scale, but constantly with deals and investment stuff, and I don't know anything about the situation that you just discussed, meaning they're the people that headed up that fund and their personal circumstances and their financials. But I would, if I really want to see the details of what they've done thus far, how deep their pockets are, what are they bringing to the table, how much money are they putting in the deal. And again, I think there's really good leverage and there's bad leverage, but some of the wealthiest people that I deal with are ones that don't have much leverage. They have a lot of property they own. And of course, that takes time to accumulate and work towards. But I don't know. I mean, again, the rates jumping up so quickly with that, no one really saw that coming. And I think in anticipation of the rents dropping a little bit, I thought that was going to happen. I thought, well, this is going up really fast. And it's to a point where it just doesn't make any sense. And anytime in real estate, from the 20 plus years I've done it, anytime anything happens really fast, up or down, something's got to give. So especially when whether it be value or rent rates go sky high in a very short period of time, it's got to come back down. That's just kind of normal. So it kind of goes without saying, but I don't know. I mean, that's my 2 cents on it. I think that you really, if you were interested in investing money in a situation like this, where they're buying multifamily or whatever it might be, I'd want to know everything. And maybe they did, but I'd want to know who's managing it, how long have they done it, who's over all this, how much money they have to lose or invested in the deal. If I were approached by a group that said, hey, we're doing all this, and I found out that it was not their money, it was someone else's, I'd be leery. I mean, I'd be, what do you have in this? If you believe in something and you're good at it, you've got money involved in it too, in my opinion, in most cases.
Yeah, like this, the big foreclosure that happened in the Dallas area. There's now a class action of 123 investors against I can't even say his last name. We're just going to call him Jay, with Apple's Way Investment Group, basically claiming our money wasn't there. Because when you get involved in these syndications, for the most part, it's it's your money's a risk. You're kind of like the common shareholder in a bank. If the FDIC takes it down, almost always the common shareholders are wiped out. I mean, that's the risk of owning a bank stock, and as well the risk of owning this.
Sure.
But I mean, there's so much to you're really giving up control of your investment to somebody else.
Yeah.
Most of us wouldn't give that up to people we're related to.
Mm-hmm. Oh, that's a good point. That's a really good point.
So it's really interesting that, you go to this pitch, and, part of these, there's always a pitch book, and, the pitch books are how they're put together is important. What they disclose is important. What they promise is important. What they can't legally promise anything, but what they project is important. But I can't say enough that the pitch book says a lot. If the pitch book is what I call guru-y, run.
Yeah.
When Wall Street, when Invitation Homes buys a tranche of properties, there isn't a 3-page bio of the syndicator in it.
Yeah, that's a good.
I mean,
it's legit. Well, I think too, checking to see what kind of experience they have thus far in doing this throughout many years. I mean, who would put millions of dollars with someone who's only done this for 2 years? And I'm not saying that's what happened in this case, but if you were looking into doing a deal and you've got someone expressing what they're about to do for you, they've never done it before, or at least have only done it for a very short period of time. And it is very easy, I found in real estate investing, to get emotionally involved in the potential benefit on the good side. No one wants to think about potentially losing everything. So you just got to be careful about that, because that's reality. That can happen. And in this case,
it definitely, one thing you want to look at is the operating agreement and the subscription agreement.
Yeah.
Every investor should be listed in it. You should know who's you're getting in the trenches with to do this with, and particularly the money. Who controls the money? Is there a third party? I've been part of some funds, and one of the officers was an attorney who, held the funds until it went to a title company. So it was in an attorney's escrow account, which is a little more protected for people than in, dude's account, who,
Sure.
just runs with it and can wire it to wherever he wants to, if that makes any sense.
Well, and how they're going to report. How regularly will you see the financials of where they're at, where they're going, where the expenses are? I mean, some, they'll do that on an annual basis. They'll do it on every 6 months. I want to see it at least quarterly, if not, more often than that. So.
Well, that too, and one really important thing, because if it's making money and they're not doing substantial capital improvements to the property, you should be getting some dividends.
Oh yeah, 100%.
So, and it should be spelled out in the operating agreement how those dividends are paid and when and all that.
Yep.
And if there's no dividends paid and we're not, putting in new parking lots or redoing the laundry room or putting a new roof on all the buildings, then why are we not, because the number one reason, so many of these properties, I've seen syndications offered where they've got a property that's upside down, that's a value add, with zero cash flow, positive cash flow with the debt the day they buy it.
Yeah.
So that, to me, you just put yourself up against the wall right the day you closed, and what would you want on that, Mike? If you've seen a clear value add, you want at least 6 months, or do you want a year in the bank of the asset?
I think worst case, well, you want at least a year. 6 months goes by really fast, and the process sometimes to turn around, especially a bigger project, can take way more than 6 months. I've got some property I bought from a package type situation that was a lot of money, and I've got a lot invested in it. And my thought process within 6 to 8 months was I could have most of this turned around. The reality of it was more like 12 months, which ended up being fine. It was, I've got another business partner in it, and it's working out fantastic now. But our guesstimate was, 6 to 8 months. It was really 12 months. And that's reality on some of these bigger projects. Well, one thing I'll add too is, so these syndications, I want to be very clear on what assets they're going after, because they're not all good. I don't know how to explain that without being be careful how I say it. But
the location too. Are you in an area that has rent control? What are the eviction laws like? And
what state are you doing it in? What are the laws for that state? Are you familiar? Have you ever owned a duplex? You ever owned a apartment building? You ever owned mobile home? You ever owned single families as rentals? Like all those asset classes that these syndications can go after, which again, some are super successful. I don't want to knock, all of them. Some have done fantastic. They've made millions. And more power to them. It's just the people heading it up. Are they funded? Do they know what they're doing? Who's managing it? What are the costs of management? Can you evict someone in 4 weeks or does it take a year? I mean, there's just a lot of factors that most people don't. It's so exciting for some people to just put money in and they feel like they've been pitched a great deal. It sounds and feels right, so they're going to do it. There's a lot of details. This is not an emotion-based decision. This is, what are the details? What are the facts? What's the paperwork say? I have an attorney review it. If you're going in, I'd have an attorney look at it that knows way more than you about it. So you have a legal perspective on it. I mean, there's just a lot of factors that I think a lot of people don't look into. And you've got to look at worst case scenario. If I'm investing $500,000 in this deal, if it goes south, does that ruin me financially forever? I mean, that needs to be taken into consideration too. Don't put all your eggs in that basket if you don't have them.
One simple, and I've done this, I've gotten a couple prospectuses recently, and it's hilarious. I get on Zillow and the rents in the area don't match what they're putting in the, and this happens, people buying onesie twosie properties. I've seen it happen here all the time, that the realtor that does nothing with property management and rentals pitch somebody for them to buy an investment property, and then the rents are $200 cheaper in in the real world application of that asset than what the investor was pitched at. I got pitched an apartment complex in Atlanta, going in on a syndication, and from what I could tell, their rents were $200 a unit higher. Go that across, I think it was like 85 units. It's a lot of money.
Oh, tons of money on your cash flow. Yeah. Well, and again, I've seen that, like you said, on a single family home rental that agent's trying to sell, and they're saying the rent's $1,800 and the rent's $1,400. Now, from a spreadsheet standpoint and cash flow, you don't have any cash flow at that point, and most likely.
Let's just make a lot of people mad with this statement. If it's a daisy chain and you're the one funding it, run.
Yeah.
I mean, there's the new lexicon where they have direct to seller or direct to broker is the new things that they put on there. And I laugh because I call them the Facebook deal makers. They get on Facebook and they post it. I've got a nuclear reactor in Chicago, and I'm direct to the owner who is related to the seller who went to high school with the cousin. That's right. And then they all post it and then they all share it. And then half of them got each other signing NDAs that they have no legal authority to make them sign an NDA, because brutally honest, if you're signing an NDA, that means that person doesn't have the deal for the most part, unless there's some real classified, some real sensitive information being conveyed. If it's just a group of duplexes for sale in Fort Myers, there's no reason to really sign an NDA.
Agreed. Yep, 100% agreed. Again, I don't want to knock anyone that's newer to the business, new to it, or wants to get into it, because you got to start somewhere. But to invest in some of these bigger funds, a guy that can raise a bunch of money because he's famous, but really hasn't done real estate very long. And again, I'm not going back to the case we originally mentioned because I don't know the background on that, so I don't want to act like I do, because I don't.
He was basically got famous on YouTube talking about real estate and then turned it into syndications.
I just got to be careful with people like that. I mean, in this case, obviously, it did not work out, and there are cases where that has worked out. I just would be really careful, because you can get lucky sometimes in real estate. You can just be in the right place, the right time, buy the right thing, and it works out. And that's what we hope always happens. But this also is an option too, where it doesn't work out.
Seeing a lot of these where they self-manage, they come up with their own company, and I would really want to know who's driving, I'm a big fan of the entrepreneurial operating system. You have an innovator and an implementer. Who's your innovator? Do they actually know what they're doing? And then whoever's implementing these ideas, have they actually implemented these, and done it successfully long term? My grandpa used to say, be leery of people that are spending money that's not their own, because they're going to do everything they can to keep it. And you're the one trying to just do business there, in your business model.
Sure.
And so a lot of times you'll see, oh, well, we're going to get our own management company. And they maximize, like a lot of these Wall Street entities. What people don't understand, like all the single family rented entities, most of them have the utilities on in their name. So that's basically they put themselves on the electric bill so they can charge service fees
Mhm.
for transmitting the electric bill to the people. Same thing with the water bill,
Mhm.
which is
Yep.
stupid because you're on the hook if they leave.
Yeah, yeah.
In most states, you can't turn off their electricity.
I don't know of a state where you can.
Yeah, I mean, but it's somebody somebody sitting in a meeting thought this was a great idea, especially the bigger Wall Street entities, the management companies theirs, the contractors are all internal, the lawn company's internal, there's so much internal, and that's why the investment is really just the reason to have our other businesses getting fed, if that makes any sense. You really have
There's
to
a lot.
watch that in
There's a
these
lot that
types
are
of
like that. A lot of those
but
groups do that, exactly what you just said. They have the investment, but they make their money off of all the other add-ons that they're getting paid to do. That's where they make tons of money that way.
yeah. And if they know what they're doing, then so be it. Like you and I are buying properties in Georgia and you're managing them, but first of all, I know where to find you.
Yeah.
And secondly, I trust you and I know you know what you're doing because you actually have owned properties of your own plus managed for others. And so, I call that a margin of safety. More importantly, I know where your boat is.
That's right.
So I
Again,
know I can find Mike if I can find his Carolina skiff.
I think too is when it comes to the investing part of it. Again, we'll go into management for a second, and that's my forte. But that's a super important part of the process. You could have the most phenomenal investment, but a constant bad tenant and turnover, your numbers are gone. And that could be on
Yeah.
small scale with 1 or 2 rentals, or that could be on a few hundred. That part's huge. And I think I recently have had people reach out to me to manage their property in the Southwest Florida area, which happens constantly. But I found a little more on the more recent side. Some are still living in the rent rates the prices we had probably 6-8 months ago, which we don't have anymore. They've gone down a little bit. And I think they might continue to go down a little bit more, but I don't think it'll be a drastic drop, but we're gonna see a drop. They're still convinced that they can get $200 or $300 or $400 more than what current market is. They have to get that because that's what they bought, planning on. So now they're it's not what they thought. And again, I've been the big bad management guy saying you can't get that. Well, no, I was told you can. So I've got buddies that are getting it. I'm like, well, good luck. I mean, put it online, advertise it, do all you
And
can.
those things last generally 3 to 5 months. The ones
and
that
then
way overpay for market, you can put a tenant in it and they usually don't make it through the lease.
Oh yeah,
In my
100%. Yeah.
experience.
So if you want high turnover, brain damage to your property across the board, it's just not a smart thing. So I don't know. The management side, I can talk about that all day long, but it's just super important. You get good paying, qualified tenants that have proven from previous landlords and with their work history, their rent history, all that kind of stuff is the only route to go. Never lower your standards. And we had someone locally reach out and say, "Hey, I was referred to you. We hear you're great. We want to do all this." And then I went over the breakdown of what we look at from a tenant standpoint. And then the owner said, "I wouldn't even qualify for that." And I said, "Well, then I wouldn't rent to you."
Yeah.
Is what I told just
Good thing you got some money then.
Yeah, good thing about money down to buy this property because I wouldn't rent to you. And it was almost as if she was like, "How can you even ask that?" I'm like, "I've done this for a long time. This is the standard you want. If you lower it, you're playing with fire because it will not work out if someone who doesn't qualify." Another thing too, some of these bigger syndications or big groups I found as I've taken over management for some, I'm assuming it's to get the top dollar, but you're not getting the best tenants. I don't even know how to explain it. Instead of getting a security deposit, they were having some kind of bond or security that the tenant was purchasing on an annual basis for not much money at all, probably $500 or $600 a year, but that the owner would get the security deposit if they default. It's the weirdest. It's like a scam, in my opinion, weirdest situation. And taking over and having some turnover because they were bad tenants, then getting that money for the owner has been a nightmare. Haven't seen one yet that came through. It's almost like an insurance policy instead of a security deposit. And we know how insurance companies pay out. Usually not so good. It's same process. And this is newer. This is something I haven't dealt with before. These bigger entities are like, instead of collecting security deposits, they're having the tenants get a security deposit insurance policy, basically is the best way to describe it.
Yeah.
And you want money out of people's pocket when they move into your property. Again, just
This is
another
something
thing.
we should talk about it at the luncheon.
Oh yeah, no, and I'm going to bring it up there too. I mean, it's just like insurance. Basically, it's an insurance policy where for pennies they get a policy, but that's not a good tenant. You want money, and you want their money in the game, their money to lose. They have to put money down so they can qualify financially to pay for your property. Again, I'm seeing that on in the masses as I take over management, where unqualified people are moving in, they're destroying property, they're not paying, and they're getting evicted or having to move out because they can't afford it.
I always
And
laugh when people talk, well, that's a lot, to qualify for a rental. I'm like, I want you to look at it this way. In this market right now, I'm entrusting you with a $300,000 asset, and you're going to pay me $2,200 a month for the quiet enjoyment of that $300,000 that's sitting there, whether it's leveraged or equity or a mix of the two.
Yep.
Who is going to not want to know who they're handing their $300,000 to and want to make sure there's a really good promise I'm going to at least get what you promised me for the quiet enjoyment of the property. And so few people, I mean, the rental side has become, there's a lot of demagoguery, landlords and the corporate. I had to laugh because we did that. Alvin came and spoke at our luncheon about the build to rent community.
Sure.
And the marketing on that was just nothing but that's why I can't own a home because of people like that. So then when I did the math, it was like 0.6% of the single families non-homesteaded in the county, I think, were owned by a Wall Street entity. And when I responded, I just put the math in there. I took copy right out of the spreadsheet, replied to the comment. How is this preventing you from owning a home? And of course, that was crickets.
Yeah.
Nobody had a response for that because it's math. It's easy to argue whatever your bias is and whatever your narratives are, but when faced with a fact, particularly that rebuts the narrative, people just hide. But
Sure.
it was the landlord side has become and on top of that, it's become a very litigious space.
Oh yeah. Oh yeah. No, I again, for what it's worth, I probably shouldn't share this, but I get threatened with a lawsuit a few times a month, every month. I mean, it's kind of like clockwork. I'm like, okay, you're mad now because you heard no, or I mean, we treat everyone the exact same, and because you have to, and you should anyway. And people get mad when they hear no, or they don't like what you come back with. When it comes to even the qualifications, I feel like that's are you kidding me? I'm like, we'll just move on to the next property. That's our qualification process. I've just found that part of it is so crucial in having longevity with a good paying tenant that takes care of your property. If they can, all those dots, the I's dotted, T's crossed, they have the decent credit, they've got money in the bank, they can put money down. That's what you want as a tenant. You don't want one that you have to break out. And we've discussed this throughout the years multiple times. You want someone to be able to pay all their money up front upon moving in. It's kind of like when you buy a house, as you're the buyer, you've got to put 10% down or whatever it is, 20% down to buy the house. You have to qualify to purchase the house. Well, you've got to qualify to put money down to rent. Look at it from the same standpoint. Less money in the game, but because you're renting it, you're not getting ownership, but you have to qualify and meet certain I don't know, expectations. And again, it's the same across the board, but I made a lot of people angry by telling them, no, sorry, you don't qualify. These are the qualifications. We're upfront about it, and they get mad. They're like, oh, we'll move on to the next. And I've seen people put complaints like Google reviews on stuff where I'm thinking like, we did the right thing, you just don't like it, so the review is bad. So what are you gonna do? I've taken over management of property where bad tenants not paying, and we had to evict a guy, and a guy put on the review, Mom always said, if I can't say nothing nice, don't say nothing at all, something like that. And I didn't, because I didn't want to open a can of worms. I wanted to put, and I think your mom wants you to pay your rent, but you didn't pay it, so we evicted you. But I didn't put that in the thing. I'll be like, yeah, I mean, we do our job and people get upset. But if you're not doing those basic things, and go back to these big funds. If you're putting money in these funds, know their processes, know how they approach things, know what the qualifications are. I mean, meaning when it comes to tenants and it comes to their financials, like there's just a lot of details that I think you get lost in the excitement of we're all going to make tons of money. And I hope that's always the case for everybody, but in a lot of cases it's not. And it's a matter of looking at what you just discussed, a lot of the paperwork and what they're committing to do, how often they report, who's holding the money. There's a lot of details that they've got to be checked prior.
most of these things that we get pitched, and I mean, that's the beauty of running a real estate investment association. Everybody pitches us everything, and
Oh yeah, constantly.
it's a
Oh
good
yeah.
time. It's really a good time getting,
Oh
some
yeah.
of them are pretty good. I've learned some stuff listening to some of the pitches. But the biggest thing is, you make your money when you buy something. For rentals, it's really, in my opinion, location. You want to buy the right municipality. You want to buy the right property for the demographics that's going to give you the best yield. That's
Yep.
also going to, long term hold its value, pay you. This really shouldn't be looked at, in my opinion, on a long term hold appreciation. It's there. You should know about it, but it shouldn't be. Nobody should buy roast beef because the gravy's amazing. At
Very
some
well
point,
put.
yeah, the roast beef needs to not be so tough that we have to pour, 2 cups of gravy on it so we can eat the sandwich. That's the basis of this. But and so, we already talked about the income, them not overstating the income. And then the next thing is they understate the expenses. My favorite is a 0% vacancy rate because the duplex currently has 2 tenants in the
Yeah.
A-Pod.
Yeah. Oh, again, the underwriting. So the underwriting, the asset. I mean, again, we're talking about these bigger syndications that are buying property in bulk, but the process to underwrite any asset is the same. I mean, it's on a larger level, but like I've seen those spreadsheets too. And again, for those that maybe are listening that are newer to the investing side of it, a vacancy rate is obviously how often percentage wise the property can be vacant, or at least putting in some kind of number, expecting that worst case scenario, there's gonna be some vacancy here at some point. Tenants move out. There's turnover. That's the reality of having rental property. And if the only way the asset works is if there's a 0 vacancy, don't buy it. Don't get involved. I'd put at least 10%, and in some cases 5 to 8, but 10 to 15% in some cases. All depends on the market. Depends on where you're at, what you're buying it at. But you've got to factor that in. If you don't,
2009, what were we using? 20, 25?
yeah, 20%. Yep.
Yeah.
Yeah. And again, we are in a good rental market. Even with prices going down a little bit, there's still demand. I mean, there's just now of what's the actual rate for a property. And what was, again, for our market, just talking in Southwest Florida, what was 2,400 now it's probably 2,200. So we're seeing a couple $100 in decline. Again, that's still a good rent rate, but it's not what it was. So if you've got an interest rate that's a 3-year balloon that's going to go up after that, you need to take that into consideration. I mean,
Plus, you've got peaking comps this year. We're starting to see a little bit of year-over-year price reduction.
Yep.
You've got peaking comps this year, which means your tax bill for next year is going to be reflecting off the comps for this year. So an intelligent landlord right now, if your rents are starting to trend down a little, which most people tend to not be at market. Most landlords, if you're doing your job and you have long-term tenants, a lot of times you don't capture that peak market number because what's it cost to turn a tenant over, Mike, today's world? Minimum
3,500 to 4,500 probably. Again, I'm being somewhat conservative, and that's both for rehab, potential rehab, and while it's vacant, you're not getting paid. So that's probably best case scenario is if you're only paying that much out on a turnover.
So if you're 200 under market rent, a lot of people would look at that as a $2,400 loss, but more importantly, you didn't have that turnover, which if you do it perfectly, you may be able to, move them in, move them out. But a lot of times things don't happen perfectly. And then as the market continues to soften or softens or whatever, it takes a little longer. I'm starting to see a lot of on Facebook property managers talking about, they have a property that's not, for a while you can move them in, move them out in a 2-day period.
Yeah. And again, I don't think that's the case anymore. One of the problems too we'll talk about just turnover and the costs associated with it, going along the lines of if you have a long-term tenant who takes care of your property, who pays on time, that you don't have issues with, I don't think it's to your advantage to go to the top of the market on the rent. If you're giving them kind of a deal, again, it's financial. This is all comes down to numbers, but let's say the top rent's 2,000 and you're at 1,850 with a really good paying tenant. Do you jump it up to 2,000? And at that point, when you got a softening market where it might next year be at 1,900, I don't know, go up 25, $50, still get the increase if you can by a little bit, but you're giving them a deal at the time because you're still 100, $200 below market. So longevity with tenants, turnover is the worst thing for investment property by far. There's no good turnover because that means there's vacancy and you're losing money.
Well, the economy's been good too, so there wasn't the issue a vacant property being, you know, you're going to show up and your water equipment and your condensing unit no longer is there.
Correct.
Which was a major, I can remember back in 2008 to like 12, the minute the property went vacant, you sent the guy out to
Cage 'em up.
yeah, to take the water equipment and put it in the garage, and we all had cages over the stuff. It was, you know, it was a different time. We currently don't have those problems.
No, I got to share this thing. It's funny. I had a contractor call me. He's in his truck with a huge trailer for his rehabbing work. And he calls me, and he called me a couple times over and over. I was on the call. I finally got over to him, and I'm en route right now, chasing behind a guy that stole AC copper out of the neighbor's property, and I'm going down this street. We're going like 70 miles an hour. I'm like, what are you calling me for? First of all, second of all, stop. It's $30 worth of copper. Like, what are you doing? And it was all, I mean,
$2,000 worth of damage to the condensing unit, though.
True, no, that part is true. But like, here's the weird thing too. Not that we don't want to help our neighbor, but it wasn't even our property. He's working at a one of the rentals, and that guy went to the like across the street neighbor. I don't even know who the neighbor was, and took his stuff. I'm like, you left a job to chase some guy that who knows has what in his car. He could shoot you up. I don't know, you know, to go with your trailer, huge truck and trailer going down this street, going after this guy for a copper. I'm like, man, just turn around, like call the cops, but turn around. Like, what are you doing? So yeah, you know, war stories from back in the day.
Yeah, I used to always laugh. Just call me. I'll give you $50. Leave my condenser alone. You know, it's going to cost me $2,000 to fix it. I'll give you $50.
Yeah,
and that's $20 more than they were going to get.
Yeah, and less brain damage for having to rip into it. So, oh yeah, that was a weird time. Because you're right, appliances, well-equipped, and ACs were getting stolen back in the day in the masses. But
because you know, a lot of these syndications, I mean, especially the multifamily became all the rage. You had the pandemic economy coupled with a very low interest rate economy. It was a very, very weird time where you had just everything perfect, you know, and now as we're returning to normalcy, you know, 2019 was kind of a normal market. You know, we actually were kind of even flirting with some corrections. I mean, year over year, we had a 1 month that actually had a year over year price reduction. And we talked about it at a meeting, you know, start watching this, don't panic, but start watching this, you know, but then everybody got used to the 20 was a little weird, you know, we got to watch, you know, Tiger King, you know, everybody was eating homemade banana bread, worrying about toilet paper and, you know, all the good times.
It was a weird year, man. That was weird.
Someday you're going to go to a probate house and there's going to be like 40 packages of toilet paper, masks and gloves and a case and a septic wipe. And this, at the time, 20 years later, somebody's like, why would they have this? But
yeah,
forgot kids. But
you know what's interesting too, then that time I know you and I talked about it. Again, we're kind of going back in the war days of real estate investing, but like I took some risks there in that time thinking this could be really good or really bad. And who would have thought that it would like double and triple in some cases the values that we bought in 2020. Like I was just like, holy cow, like that was some of the best investing ever. Some stuff we bought then. I mean, it was amazing. So
yeah, the hindsight, you know, hindsight's always in like hindsight 2006, sell everything you own and buy gold.
Mm-hmm. Yeah.
You would have been committed.
Oh, yeah.
To go into a room full of people that do that that invest particularly in real estate and say, I just sold my whole portfolio and bought gold.
Yeah. Oh yeah, they'd be like, what is wrong with you? Oh yeah.
And then you think about it in 2020, when the market shut down, buy everything on leverage.
Yeah.
You know, but who would have seen that coming? I didn't see it coming. 100% did not see it coming.
No, I'm with you there. Yeah, it's kind of surprising that coulda, shoulda, woulda in some cases, but I mean, I took some risk and it was phenomenal. Like, you know, you've said this too, and this is going back to people that are contemplating investing or what to do. You know, you can't win or lose if you're not in the game at all. So a lot of people that are on the sideline not doing anything, you got to do something, or you can just keep on watching podcasts and listening to gurus and whomever. But if you don't, you know, you don't try, you can't win or lose.
If you have more money in seminars than in property,
that's
something is wrong.
That's a problem.
This is a hobby. It's not training, you know. And I talked to a guy, came to a meeting, he probably had in his lifetime, he said he spent $100,000.
Wow.
I was like, bro, that's like 2 manufactured homes with tenants in them in Georgia.
Yeah. Yeah. Like, what are you doing? Yeah. Well, I had a guy too. Actually, I had a guy call me yesterday and said, "Hey, I'm looking for a mentor and real estate, creative real estate investing." And he had, I think, very sincere intentions and what he wanted to accomplish. And then I say, I don't have one that I can recommend to you with confidence that's going to not just take your money and say, "Hey, thanks for a good time." So you just got to be careful too, who you partner up with, who you're doing business with. And Jeff, we get reached out to all the time by gurus that want to come speak at our meetings. And what do you end up asking them every time?
Yeah, just send me your redacted 1040s. If your 1040s reflect your sales pitch, we'll get the calendar out and put you on there.
And we're still crickets every time. Yeah.
There's some out there that are real.
Oh yeah.
But there's that, and I crack up because there's just different waves. Like the same concepts just keep getting reinvented with a new. My favorite was house hacking. I'm like, it's a cool new term for something that our grandparents did.
Yep.
So,
well, again, and I agree with you though. There are legit individuals that do this and are very successful at it and can show you how to do things. Show anyone how to do things. That is legit. You just gotta be careful because not everyone's legit. And some
irony, the time to do syndications is coming because there's going to be all these failed syndications.
Yeah, and that's when you buy them up for pennies.
Yeah, and then you go in and grab them up and figure it out. I mean, particularly the principals are always non-recourse, so the bank doesn't really have anybody to go after, and they just want it off their books.
Yeah,
but I really see the time to do that is now. What problem is your cost of capital? I mean, you can get a money market account 5%.
Yeah.
And I honestly think we're doing this video on June the 1st. I honestly think they're going to raise rates again in July. I think they're going to have to. I'm hoping they don't, but I think they're going to. I think we may even have 2 more rate increases because inflation's pretty sticky still. Yeah. But as these syndications and there's a bunch around town I'm seeing coming out of the ground that I really hope they have fixed rate debt on it because they're wound super tight. Most of the inexperienced operators don't do a fixed rate because it's higher, and then don't pay for rate caps because it's more expensive, and because they're just trying to juice up the returns as much as they can, at that moment that you buy it. And, anybody that's owned a property long term, I think a great exercise to do is when you first buy a property, do an APOD, which when you join, you get an email. It's one of the spreadsheets you get from us.
Yep.
Do an APOD on it and save it and go back in 5 years and see what you thought it was going to be.
True. Yeah.
Even a year later, like any smart investor should be APODing at least parts of their portfolio every year just to see what the yield is. If, to see, what you should do. Should I 1031? Should I do something else? But, save that APOD because once you get going in the holding a rental property thing, it never quite turns out like you thought it was. You're fine and you make money and, you've got depreciation, which is a great thing, but you also have to, you have to make money. And so many of these assets are wound so tight, the first hiccup in the economy, they're going to be upside down.
Oh yeah. Yeah. No, I agree. And I think I'd be very conservative right now with if anyone's buying, I'd be conservative. If you have the cash to do stuff, buy property. If you're not, you can get a decent return on it. But if you're with debt, purchasing assets right now, I'd be very conservative on your vacancy rate. I'd be conservative on your rent rates. I would anticipate increases in property taxes. And insurance, the insurance guy always follows the property tax guy. So those will go up, and anticipate that because your margins will shrink when that happens, and you need to be ready for it. And again, you get the right deal, that's okay, but you need to be ready for it. So you're not,
because it's all about long term. I mean, this year at the Berkshire Hathaway shareholder meeting, listen to those people, put it on the internet. I mean, those 2 guys are just a living example, and you can say all you want about this and that with Buffett and Munger, but not everybody's been perfect in their life as far as their investments, but they buy quality assets and then never sell them.
Yep.
And they bought $1.3 billion worth of Coke stock in 1987. Last year, their dividend, I think, was $560 million. To do the cash on that.
Oh my gosh, that's insane. Yeah.
But if it had went up to 1.7 billion, you could have flipped out of that stock and paid the tax and looked brilliant. you look smart there too, but who looks smarter? 30
Well,
years later, 50% cash on cash annually, or a chunk of money that you got to figure out what to do with.
and pay a bunch of money to
Yeah.
a bunch of taxes on. Yeah. Anymore, I look back on what I've sold on real estate assets I've had throughout the years. And every time I've sold something, I look back and I'm like, man, I wish I would have sold that. Anything I've learned, buy and hold. And if you do sell anything, 1031 it into something else and keep on owning stuff. The flipper, I would love to have a conversation, or maybe we can do a meeting about that of nothing wrong with flipping property. Don't get me wrong. You got to raise capital somehow, and that might be the way you do it. But if I look back on every property that I've flipped, there are very few that I'm happy that I don't own. I mean, I wish I owned everything still, because that, that chunk of 50, 60, 70, even $100,000 is so cool. But then you pay taxes on it, and then you pay living expenses out of it. And then what are you left with? Unless you reinvest it in a good way. And in a lot of cases, I was young and doing it, and I thought, oh man, I just made 20 grand. This is amazing. Looking back, I would take $200 or $300 or $400 a month off the asset for the next 20, 30 years over the $20,000 they have to pay taxes on, and then it's gone within a short period of time. I'd take that ongoing cash flow all day long. Imagine having 500 of them. That would be, that's a pretty good life. So
yeah.
And
if you're really thinking about, syndications, or you just want to educate yourself on syndications, I would Google Apple's Way Investment Group. That's the guys that just lost the property, the group that just lost the properties in, I believe it is Houston, Texas. So not to beat them up. Everybody makes mistakes. Nobody's perfect, but syndications can be a great way to employ some capital. They also can be a great way to have a capital loss, and then you'll be sad. Losses make people sad. No one wants to be sad.
And then they bring lawsuits, and it's kind of an ugly situation.
Yeah, I mean, attorneys love these things.
Yeah, attorneys are salivating.
It starts with writing a $15,000 check to an attorney for the legal work so you can do it. And then if it doesn't go as planned, then the lawyers get to defend you. And then all the people who wrote the check hire lawyers. Syndications are a wonderful thing for the legal profession. I think a lot of people have made a lot of money in them, but you really have to, first of all, know who you're doing, know who you are handing capital to. Yeah. And then secondly, once you figure out, by knowing them, do they know what they're doing? What assets are we buying? Are we buying Class C assets in Detroit? You can get them cheap.
I ain't touching that.
And there's some parts of Detroit that are really on the rebound and doing amazing. Yeah. So there's some parts of Detroit that are, people have made at the time, you might have laughed at what they bought, but the parts of the city's growing, parts of the city's not. But
you have to know what you're doing. So I agree with you. If you've got a guy that's their backyard, they know exactly how to do it, and they're doing it on a mass scale now for you, and they've shown years of experience of doing it well, more power to you. It's the guy that's never been to Detroit that's like, we're going to buy up the whole city and take over. It's like, that's not a good game plan, man. You've never done it. You don't know the ins and outs. I wouldn't be jumping on that bandwagon.
Yeah, but that's really on these. I mean, the rent's easy to verify. Zillow, just look at Zillow. What's rent? What's for lease? Expenses. First thing I'd verify is tax bill.
Yeah, which is also online, easy to do.
Yeah, what's the tax bill? Especially most of these are 250 units and up. What's one AC service call cost?
Which again, easy, and that's $150. I mean, for what it's worth. But all these expenses are very easy to verify. Even insurance. You can call an insurance company in the different state and say, hey, I'm looking to buy this property. Can you give me an idea of what the insurance would run? Those are all due diligence things you could do prior to getting involved in an investment.
Like the new world we live in, I don't think I would invest in a syndication unless it was the criteria we only buy flood zone X.
Yeah. Because
right now, flood insurance, thanks to Ian, we need to make Ian Boakes change his name too.
Yeah.
One of our corporate sponsors. We're gonna Ernie Boakes. But yeah,
Ian the Hurricane, not Ian the contractor.
Yeah, but thanks to Hurricane Ian, I mean, flood insurance is going to be problematic for a very long time, and they're going to go wide with how they get the funds back for all the claims they paid. Because you got to realize, I mean, I don't think we've ever had 2.5 counties flooded.
No,
that I can remember.
Not that I'm aware. Yeah. They say the storm was 1 in 500 year storm.
I hope so. I don't think I can do this again.
But I'm fine with that never happening again. Yeah. No thanks. So
So any closing questions? I mean, I thought this was something interesting to talk about. It's all over social media. The Wall Street Journal did a big article. Everybody loves to jump on something bad.
Yeah.
Everybody likes to, it's the irony is the amount of people that are cheer a failure as opposed to cheer a success. And there's a lot more successes than failures, but the key to having a success is, launching from a stable position of knowledge, not this was a really good pitch and I'm fired up and maybe I get to have a drink with this guy at the bar after the pitch. And, that never turns out well.
No, and I'll end on that. I mean, that's just probably my closing thought is there are a lot of groups that are savvy, that are experienced, that know what they're doing, that I would highly recommend working with. If you can dot all the I's and cross all the T's and do your own due diligence prior, because there's a lot of groups that have been around for years and years that are very successful. You just got to be careful about the ones that are popping up, that are newer, and again, not to knock someone for wanting to get into it with good intentions, but there's way more to it than that.
Yeah, I don't think anybody goes into this saying I want to have a $12 million lawsuit against me in a couple of years. Nobody says that.
But it happens, and
Yeah.
you're right in saying that. And I've got a few people that I reach out to on investment related stuff. You being one of them, obviously, but some guys that I've dealt with for years and years who have done it for 30 or 40 years, and they're old school in a lot of their approaches, but what they've done for 30 or 40 years works.
No, that's call and take the abuse from Dana on a phone call, but you'll get the
end result. Yeah. I mean, I've got a couple of guys that I manage for, but that I reach out to and say, what are your thoughts on this? I'm thinking about doing this. And they will be brutally honest. And that's what you want. You don't want someone to tell you what you want to hear. You want to hear what reality is. And but again, you can make a lot of money if you do this the right way. Just make sure you check everything as thorough as you can. And again, at the end of the day, it's a risk. We can't control. There's a lot of things we can't control in real estate investing, and you can lose money, but you can also make a killing if you do it right. So, and it is
that was something too. I'm looking at all these. I know we're supposed to be closing, but I'm looking at all these multifamily deals, and some of them are probably going to be in the negative here real quick, especially as the first time the dividends don't work, everybody raises heck, and you end up changing a management company, or you start putting different players in. And at some point, they're going to hire somebody that knows what they're doing. If they had their own in-house company with their two cousins and their, aunt doing the books, which is a lot of these in-house management companies.
Yeah.
And then, you figure out where, you've got negative cash flow.
Yeah.
Okay. And you're slightly upside down now because your cash flow, determines your exit price on these things. Right. I guess you figure out how big the check you're going to write is. And, if it's a $100,000 check, do you just get out of it?
Yeah.
If it's a $10 million check, well, you just see what, I guess, what do you do? I guess you call Jasinski, because he was the king of that back in, the last market.
Yeah.
But you just have, I mean, that's like looking at this, if, put yourself in there, you're sitting in around that conference table. What are they going to do? Because somewhere in there lies the opportunity. The last thing I'm going to do is go in there and be the angel investor and throw a bunch of good money into a bad investment. And let's all buy time together and hang out. That's terrible.
Terrible idea. Yeah, I agree.
I mean, that's the next thing of these. You've got a lot of these syndications are failing. A lot of really big names we're probably going to see coming around. Something we talked about Dana, something he said to me in late 2007. We were having just a conversation back and forth, and he goes, all your heroes are made of cardboard. You just don't realize it right now.
It's just true.
100%. We were all made of cardboard for the most part by the end of that cycle. But the key to real estate investing is become what I call anti-fragile. And that 200 door zone free and clear, you're bulletproof. Oh yeah. No matter what, they'll give you a bucket of tomatoes to live there. If we hit Mad Max time.
Well, yeah. Well, the one thing too is, do you want to own 10 properties all with leverage, or do you want to own 3 or 4 with no leverage? Again, your risk tolerance or whatever you want to do is your own personal situation based upon whatever's going on in your life. But I mean, if it's me, I'll take the 3 or 4 units paid off than the 10 that are levered in some situations, depending on the.
I mean, in a rising market, the leveraged ones make sense if you plan on trading out of them.
Right, 100%.
Yeah, but then again, when the minute it's not going up, leverage properties, that's the albatross about your neck.
Correct. And again, another option too, that a lot of people don't think of. I've got 10 properties, scenario, and they're all levered. Well, sell 5 and pay off the debt, the other 5, keep the 5 or 4, whatever it is, and then hold on while you go through a correcting market and you got a lot of cash in the end that you can reinvest once the dust settles. And again, we're not at no dust settling, and I don't see some catastrophic fall by any means, but we're in a correcting market. You need to constantly be on top of it and watching everything, because that's where we're at right now.
Yeah, because once you hit bottom, that's the time to feast. It's almost impossible to market time.
Yeah, timing that.
It's almost a fool's errand to market time, but you've got, in every correction, you've got the valley, and then in the valley, there's always a ditch. Like the ditch for us was August of really July of 08 to about the beginning of 09 was just the most nastiest part of the correction.
Yeah.
But at that point, the feeling on the street and the feeling in the market, we were raising capital then. Those were on the heels of Bernie Madoff too. And we were raising capital to buy distressed debt. And those were some of the most intense meetings I've ever been in. And I was a Marine. Yeah. So, I mean, the one guy yelling at us, I mean, he wasn't as good as my drill instructors, but he wasn't far behind. I'll find you if you take my money. But he did a good job. I mean, I recognized the quality work from my time in the military. But the problem is with the market timing is, if you've never been through one of them, really hard to do business, really hard to get any type of capital. 2008, 9, 10, you walked over 50 deals to walk in the office to find capital. 2020, I was walking, or 2021, I was walking over 50 pots of capital in the office trying to find a deal.
Yep.
So
pendulum swung different direction. Yeah. So
anything else? Well, I know we already tried to close once and then we rambled. So
what we do, man, we're good at it. We're consistent. No, I think we're good. It's a good meeting. We'll get this out to everybody, and we'll include too, if you guys want, we'll include our emails and contact information, and somewhere in the link so you guys can reach out if you have questions. So
cool. Enjoyed it.
Thanks, man.